Only 22,000 jobs added in August. That's not a slowdown. That's the job market hitting the brakes on a downhill slope.
Welcome to the Deep Dive, your Friday morning shortcut to making sense of, the chaos that seems to be unfolding in the economic landscape. Today, we're diving headfirst into some really high-stakes economic data that just landed, and I promise you the numbers are nothing short of shocking.
Indeed, and that shock is precisely what we're here to dissect for you. Our mission today is, to pull back the curtain on the dramatic and frankly pretty alarming slowdown in the U.S. labor market.
Right.
We'll explore how this is forcing the Federal Reserve into an almost urgent pivot towards potential rate cuts.
Yeah, you can feel that shift coming.
Then we'll connect these dots to the persistent, often quite painful impact of tariffs on both manufacturing and consumers. We want to illustrate how these forces are not just isolated events, they're deeply intertwined.
Ultimately, we're here to help you understand what these complex shifting dynamics signify for the broader economy and, crucially, for your own financial understanding and, decision-making. As always, our goal is to extract the most important nuggets of knowledge and insight from the shared source material, ensuring a clear, engaging, and hopefully comprehensive journey through these critical topics.
Okay, let's unpack this. And with the urgency it absolutely deserves, because the Bureau of Labor Statistics, the BLS, just delivered a bombshell that caught almost everyone off guard.
Completely.
Their August jobs report, released just moments ago, shows a paltry 22,000 new jobs added to the U.S. economy last month. 22,000.
Just 22,000.
To put that in perspective, we've grown accustomed to seeing numbers in the hundreds of thousands, right? This isn't just a slight dip, it's like a near-complete halt in job creation. It raises immediate red flags about the health of our economic engine.
And that figure of 22,000 is precisely why this report has caused such a stir. To contextualize it for you, most economists had forecast a creation of around 75,000 new jobs for August.
75,000 expected.
Exactly. So the actual figure is not just a miss, it's a monumental underperformance. A two-thirds miss, roughly. This data point is a clear and, frankly, undeniable signal that the U.S. labor market has continued its dramatic summer slowdown, as our sources describe it.
Dramatic is the word.
What's equally notable is that alongside this weak job growth, the unemployment rate did tick up to 4.3% in August.
Okay.
Now, while this specific rise aligned with some forecasts, the combination of just meager job creation and an increasing unemployment rate unequivocally points to a loosening labor market.
So it's not just fewer jobs, it's more people looking too.
Correct. This isn't just some transient blip. It's the latest data point in what is really emerging as a concerning trend. It indicates a significant shift from the robust, often overheated job growth we've witnessed over the past few years. It suggests the economy might be shedding its resilience faster than maybe we anticipated.
Right. And just to give you a palpable sense of that deceleration, just cast your mind back to July's initial report. That came in at 73,000 jobs created.
Which felt soft even then.
Exactly. Even that felt a bit soft to some, hinting at a cooling.
Right.
But now, seeing August 22,000, it really underscores just how quickly the brakes have been applied. It's almost whiplash-inducing,
Absolutely. And here's where it gets really interesting, because these initial reports, especially during periods of economic volatility, they're rarely the final word.
The revisions.
Exactly. We need to talk about revisions, which often paint a much clearer and sometimes starker picture of what's truly happening under the hood.
Okay.
So while July's job creation figure was actually revised up slightly from that initial 73,000 to a still modest 79,000.
A little bit better for July then.
A little. But the revisions to June's data were far more negative, as one source put it.
Uh-oh.
June, which was initially estimated to have added 14,000 jobs, was revised down significantly. It now shows a loss of 13,000 jobs for the month.
A loss. So June actually went negative.
Negative 13,000. That's not just a change. It's a complete reversal from slight growth to an actual contraction.
Wow. A loss of 13,000 jobs in June. That's not just a downward revision. That's like finding out your new car actually has negative mileage, like you said before.
Yeah.
It fundamentally alters our perception of the recent past.
It really does.
And when you factor in these revisions, it means that over the last 3 months, June, July, and August, the U.S. economy has, on average, created fewer than 8,000 new jobs.
Fewer than 8,000 per month on average.
That number is staggering. It's not merely a slowdown, it's a near stall. It paints a much weaker and frankly more concerning picture of the health of the labor market than we'd previously understood.
Precise.
And to underscore the consistency of this downward trend, remember that in early August, June's job growth had already been brought down to 14,000 from an even higher initial estimate. So we're seeing a pattern here. Initial reports often being overly optimistic, only to be corrected downwards later.
And this consistent pattern of significant downward revisions doesn't just correct the record. It's a stark reminder of the inherent lag in real-time economic data, especially when the economy is at, an inflection point like this.
Yeah, it's hard to steer when you're looking so far behind.
Exactly. The real insight here is that official statistics might be consistently painting a rosier picture than reality, which makes the Federal Reserve's job of timely, data-driven policy incredibly challenging. We're essentially driving by looking in the rearview mirror, but the road ahead is curving much faster than anticipated. This gap between initial perception and revised reality can lead to policy decisions that are just out of sync with the true state of the economy.
And it certainly comes with its own share of drama, doesn't it? I mean, after the July jobs report revealed that massive revision downwards 258,000 fewer jobs in May and June than previously thought, President Trump took the pretty drastic step of firing the head of the Bureau of Labor Statistics.
How does that happen?
Now, that kind of response to unfavorable economic data feels less like careful policy adjustment and, well, more like something out of a reality TV show where the messenger gets blamed for the bad news.
Well,
We're simply reporting the facts of the event as presented in our source, of course. It just highlights the intense political pressure surrounding these numbers.
it certainly does.
So beyond those alarming headlines and the revisions, what else can we glean from this latest report? Let's talk about wages for a second.
Okay.
Average hourly earnings, for example, rose 0.3% over the last month and 3.7% over the prior year in August. Interestingly, these figures actually matched Wall Street's expectations precisely.
Right on the number.
So this stable wage growth, even amidst such a dramatic job slowdown and these negative revisions, it feels like a bit of a contradiction, doesn't it?
It does seem counterintuitive at first glance.
Does it suggest lingering inflation pressures are still lurking beneath the surface? Or perhaps, I don't know, a surprising resilience and worker bargaining power for those who are employed? How do we reconcile these two seemingly opposite signals?
That's a crucial distinction, and it really highlights the complexity of interpreting these reports. While the headline wage growth held steady, it's important to remember that average can sometimes mask underlying disparities.
Sure.
For the target audience who follows these topics closely, this stability in wage growth, even as job creation falters, could indicate a couple of things. First, it might mean that even with fewer new jobs, the existing labor pool still commands some pricing power, potentially sustaining a floor under inflation.
Okay, so stickiness there.
It's exactly stickiness. Second, it could be a sign of that labor market stickiness, where employers are just hesitant to cut wages for their existing workforce, even if they're slowing down hiring dramatically.
They don't want to lose the people they have.
Precisely. This reluctance to reduce wages could be due to fears of losing skilled workers or damaging morale, which, would have long-term productivity implications.
Makes sense.
And to get a fuller picture, we need to look beyond just the BLS report. For instance, private payroll provider ADP, in their report out Thursday, showed 54,000 private sector jobs created last month.
54,000. That's higher than the BLS total of 22,000.
It is higher. It highlights potential discrepancies due to different methodologies, survey periods, or even definitions of jobs. The ADP report, drawn from a vast dataset of actual payrolls, often provides a slightly different lens.
Right.
Then, looking at the Labor Department's data on unemployment claims, initial filings for unemployment insurance tallied 237,000 last week.
Okay, 237K. How does that compare?
That's the most since June. So it indicates an uptick in new unemployment claims. So while those employed might still be seeing wage increases, the combination of weakening job creation and rising initial claims suggests that the difficulty of entering or re-entering the labor market is becoming a significant challenge, even if the overall wage picture remains stable for those already in a job.
So it's getting tougher out there if you're looking.
It speaks to a kind of bifurcation. Relatively stable for those in, but harder for those out.
Okay, so if this broader picture is one of deceleration, a significant slowdown, then where exactly are the specific pressure points? Where are jobs being won and lost within the economy? The BLS report offers a fascinating, almost granular look at this, doesn't it?
It does. And what's fascinating here is the sector-by-sector breakdown, which reveals a more targeted slowdown rather than a uniform one across the board.
Okay.
Education and health services stood out as the largest job creators, adding a pretty robust 46,000 employees during the month.
46,000 in just ed and health.
Yeah, this sector often proves to be quite resilient, almost counter-cyclical, during broader economic weakness.
That's a crucial point. Why do you think these sticky sectors like healthcare and education might be more resilient or even countercyclical during a broader economic slowdown? Is it just constant inelastic demand regardless of the economic climate?
That's a large part of it.
Or is there something else at play, maybe a structural component that makes them less susceptible to the cycles we see elsewhere? And maybe is this resilience a bit of a double-edged sword? Like, while it provides stability, does it also mean these sectors become less dynamic, potentially masking deeper economic issues if all the growth is concentrated there?
You've really hit on a key insight there. It's largely due to that consistent, often inelastic demand you mentioned. Healthcare, for instance, is not really a discretionary expense for most people.
Right, you need it when you need it.
Access to care remains a fundamental need regardless of economic conditions. Similarly, education, particularly higher ed or vocational training, often sees stable or even increased demand during economic uncertainty as people look to upskill or retool.
Trying to improve their prospects.
Exactly. These sectors have a certain foundational resilience that allows them to continue growing or at least remain stable even when other parts of the economy are struggling. They are just less exposed to the swings in consumer confidence or corporate investment that impact other areas.
Makes sense.
However, to your point about it being a potential double-edged sword,
Yeah.
yes. If all job growth is concentrated in these less dynamic, often government-subsidized or regulated sectors, it could indeed mask broader weakness elsewhere.
Right.
It means other, more cyclical or growth-oriented sectors are contracting, which can ultimately drag on overall economic dynamism.
Okay, so where were the losses then?
On the flip side of that resilience, we saw some sharp losses in other areas. Durable goods industries, think manufacturing of long-lasting products like cars or appliances, shed 19,000 jobs.
19,000 gone there. That's a direct indicator of slowing industrial activity.
It is. And business services industries, which often act as a kind of bellwether for corporate health by providing support functions to other companies, they lost 17,000 jobs.
Oof. Another bad sign for corporate spending.
And additionally, the government sector also trimmed 16,000 jobs in August, reflecting either budget constraints or maybe just a general tightening in public sector employment.
And these industry shifts really paint a vivid picture of underlying economic stress in certain areas, don't they? It's not uniform, it's targeted. When you see losses in durable goods and business services, that points directly to manufacturing and corporate spending, often those early indicators of broader economic contraction.
That's exactly right.
Okay, let's shift gears slightly to another crucial piece of this puzzle. The JOLTS report. That's the Job Openings and Labor Turnover Survey released just this past Wednesday.
Ah, yes, JOLTS.
And this report is particularly striking because for the first time since April 2021, there are now more unemployed Americans than there are open jobs. That's a truly significant milestone, isn't it? It fundamentally alters that supply-demand dynamic we've been accustomed to for so long.
If we connect this to the bigger picture, it certainly is a major development. The latest JOLTS report from the Bureau of Labor Statistics showed that the ratio of job vacancies to unemployed workers fell below 1. Specifically, it landed at 0.99 in July.
0.9, so just barely flipped.
Just barely, but flipped nonetheless. This is the lowest that ratio has been since April 2021, when it was 0.96. For an informed audience, this metric signifies a crucial and quite profound shift in the labor market balance.
So it really feels like a turning point.
For a long time, we've operated in a seller's market for labor, right? More jobs than job seekers, indicating a tight market where workers had significant leverage.
The Great Resignation era.
Exactly. Yeah. Now, that dynamic is flipped. This doesn't just indicate a cooling. It points to a rebalancing that could significantly alter worker bargaining power and wage dynamics going forward. That era, fueled by abundant opportunities, might be giving way to a more challenging environment for job seekers.
And indeed, economist Alison Srivastava put it quite succinctly, didn't she? She noted that unemployed workers are staying out of work for longer, even as layoffs remain low.
That's a key observation.
She suggests the shift is less about an increase in people losing jobs and more about a decline in job openings. So the challenge, as she puts it, is less in job security for those already employed and more in the difficulty of re-entering the labor market once you're out of it. That's a really important distinction because it changes how we view the problem. It's not necessarily about a wave of pink slips hitting everyone,
Not yet, anyway.
but more like a drying up of opportunities for those seeking new roles. And total job openings for July also came in at 7.18 million, which was below the 7.38 million expected by economists and down from 7.36 million in June.
So openings are shrinking.
Right. So if the JOLTS ratio has flipped, meaning more job seekers than openings, what's the fundamental insight for the average worker listening to this? Does this signal a return to pre-pandemic labor dynamics? Or are we witnessing maybe a new, more structurally difficult environment for reentry, almost like a permanent scarring for those who lose their jobs now?
That's an incredibly astute question, and it gets right to the heart of the potential long-term implications. For the average worker, this flip in the JOLTS ratio means a noticeable power shift.
Yeah.
While it might not immediately lead to widespread layoffs across the board, the process of finding a new job or transitioning between roles will likely become considerably more difficult and protracted. We could see a return to a more competitive job market, where employers have greater leverage in setting wages and conditions.
Less bargaining power for workers.
Potentially, yes. Is it a return to pre-pandemic dynamics? Partially, perhaps, in terms of that raw supply-demand balance. But the scarring concern you raise is very real. If people remain unemployed for longer periods, their skills can depreciate, their professional networks might weaken, and their confidence can erode, making re-entry even harder down the line.
It's a vicious cycle.
It can be. This creates a risk of structural unemployment if people are out of the labor force for extended periods, rather than just experiencing a cyclical slowdown. It suggests that if you're out of a job now, it's not just a temporary pause. It could be a significant hurdle to overcome.
Okay, that's a sobering thought.
Now, despite these concerning trends, it's important to offer a counterpoint to immediate dire recession narrative.
Right. Let's get the other side.
Some Wall Street economists, like Bank of America senior economist Theta Fuse, suggest this doesn't necessarily signal an imminent sharp recession.
Okay.
Fuse notes that while the labor market is slowing substantially from its peak, conditions appear close to the long-term non-inflationary level the Fed has aimed for.
The mythical soft landing.
He's suggesting we might be moving towards a more sustainable equilibrium, a kind of soft landing scenario, rather than spiraling into a deep downturn. He views this as a necessary cooling, almost, rather than an outright collapse.
That's a crucial distinction. And Bave also offers some interesting insights into labor supply that kind of bolster his perspective, right? He mentioned that labor force participation in July fell to its lowest since November 2022.
That's right, participation dipped.
And he potentially linked that to the U.S.'s aging population and maybe the Trump administration's immigration policies. How does that factor into his perspective that the market isn't outright weak, especially when we consider the broader picture of labor availability?
That's where the nuance truly comes in. Bave's perspective is that, and I quote him loosely here, I wouldn't say this is an outright weak labor market because, again, to the extent that the supply of workers has also cooled off, that's actually helpful for the workers that are still trying to find jobs.
Okay, explain that. Fewer workers competing.
Essentially, yes. His argument is that if fewer people are actively looking for work, maybe due to retirements from an aging population, or potentially more restrictive immigration policies reducing the influx of new workers, then the supply-demand balance for those who are actively seeking employment might not be as dire as the raw job openings number alone suggests.
Oh, okay.
The pool of available workers is shrinking, even if the number of new jobs is also shrinking. This can prevent a massive glut of labor that would drive down wages significantly.
Interesting angle.
He also points out that the ratio of vacancies to unemployed has been steadily falling, not sharply plummeting.
Gradual, not sudden.
Exactly. This suggests a non-linear recessionary collapse, the kind characterized by sudden, dramatic job losses and a surge in unemployment, isn't occurring right now. Instead, it's a more gradual rebalancing, which he sees as a healthier, more controlled cooling of a market that was previously running, frankly, too hot. It's a re-equilibration rather than a crash.
A controlled descent versus falling off a cliff.
That's one way to think about it.
All right, now let's turn our attention to arguably the biggest implication of all this labor market data. Its profound impact on the Federal Reserve.
This is the big one.
And here's where it gets really interesting, because we're not just talking about minor adjustments here. St. Louis Federal Reserve President Alberto Musalem. Now, he has been widely known as a steadfast Fed hawk, right? Someone consistently outspoken about inflation risks, usually advocating for tighter monetary policy,
Very much a hawk.
has notably softened his tone. This is not just a shift. For a figure like Musalem, this is a dramatic, almost startling pivot. It's like watching a hawk sprout, I don't know, dove's feathers or something.
It's a truly significant development, absolutely. And for anyone watching the Fed closely, it signals a potential sea change.
Right?
Musalem, in a recent speech at the Peterson Institute in Washington, D.C., stated that he now expects the job market to cool gradually and, remarkably, he downplayed long-term inflation concerns.
Downplayed inflation.
Musalem, exactly. This marks a notable shift in his long-held hawkish stance and, as our source material suggests, could open the door for support for rate cuts this fall.
Wow.
For a known inflation hawk to temper his concerns like that and acknowledge a cooling labor market, it suggests a fundamental reevaluation of the economic landscape is happening, even from those previously most committed to fighting inflation aggressively.
It feels like the balance of risks is shifting in his mind.
It implies that the risk of economic contraction is now outweighing the risk of persistent inflation in his calculus, yes.
He even offered a stark warning, didn't he? Saying, with the pace of hiring low, any increase in layoffs could produce a more substantial labor market weakening than would occur in a more active market. That's a pretty strong statement coming from him. It sounds like he's saying we're kind of teetering on an edge here.
Absolutely. That statement from Musalem is not just strong. It underscores a growing concern among some Fed officials about the nonlinear nature of labor market downturns.
Things can go bad fast.
His worry is that if the already low pace of hiring suddenly reverses into increasing layoffs, the market could tumble much faster than a slow creep downwards. It's a proactive caution, indicating that waiting too long for definitive signs of collapse could be, well, disastrous.
Get ahead of it.
And Musalem also explicitly tied this evolving outlook to tariffs. He stated that profit margin pressures related to tariffs could contribute to such an outcome.
Okay, linking tariffs to potential job losses.
Yes. And crucially, he anticipates that the effects from tariffs will work through the economy over 2 to 3 quarters, and significantly, that the impact on inflation will fade after that.
So he sees the tariff inflation impact as temporary.
That's what it suggests. This highlights a profound shift in his outlook, where he now seems to see tariffs not just as a short-term price pressure that requires higher rates, but as a factor that could lead to broader economic weakening, ultimately influencing the Fed's stance on future inflation by becoming, perhaps, disinflationary.
That's a very complex calculation for a known hawk.
It is very complex.
And adding to this chorus of shifting opinions, and perhaps with even more directness, is another influential Fed voice, Governor Chris Waller.
Waller's been quite vocal.
He's been even more explicit, hasn't he? Reiterating his desire to cut rates at the Fed's next policy meeting, scheduled for September 16-17, it's not just a hint, it's a clear statement of intent from him.
This raises an important question, though. Why the urgency from Waller?
Yeah.
He's openly expressed concern that the job market is weakening, and he wants to stave off any real drop. He's known for his stark warnings, and he certainly delivered one in vivid terms, cautioning that when the labor market turns bad, it turns fast in a nonlinear fashion. It doesn't just kind of creep up.
There's that nonlinear fear again, falling off the cliff.
Exactly. This implies a proactive rather than reactive approach is absolutely necessary to prevent a sudden precipitous collapse that would be far more difficult to mitigate after the fact. He's essentially saying the Fed needs to get ahead of the curve, not just react to what's already happened in the rearview mirror.
And Waller isn't just talking about a single token cut to appease the markets, is he? He sees the need for multiple cuts over the next 3 to 6 months to get to the so-called neutral rate of 3%.
Multiple cuts. That's significant.
Now, for our informed listeners, as you know, the neutral rate is that theoretical level designed to neither spur nor slow economic growth. But the real challenge for policymakers, and economists constantly debate this, is that the neutral rate isn't some fixed beacon. It's a deeply theoretical and constantly shifting target, right?
It's notoriously difficult to pinpoint in real time.
It's influenced by everything from demographics to global savings rates. So Waller's call for multiple cuts isn't just about moving the needle. It's about trying to hit a moving target that no one can precisely locate, all while the economy is potentially losing momentum. That's a fairly aggressive forecast for dovish action.
It is indeed an aggressive forecast, and it reflects a genuine apprehension about the speed at which a labor market downturn can manifest.
He's not alone in this thinking, though.
No, he isn't. Atlanta Fed President Raphael Bostic also noted the cooling job market warrants a rate cut, echoing those same concerns, that if the job market were to really turn, it could deteriorate quickly.
Bostic, too. Okay.
Yeah, Bostic still maintains his concerns about tariffs impacting inflation. That hasn't got away from him.
Right.
But the overriding fear of a rapid labor market downturn is clearly influencing multiple Fed officials now. The consensus seems to be building that the Fed's previous stance, designed solely to combat inflation, might now be overly restrictive given the changing economic signals.
It's a balancing act.
A very delicate balancing act, and the pendulum appears to be swinging, maybe quite rapidly, towards prioritizing labor market stability over just inflation fighting.
So, with these explicit signals from influential Fed members and that truly shocking August jobs report landing, how has Wall Street absorbed all of this? I mean, Wall Street's confidence in this cut seems higher than my confidence in finding a cheap coffee in New York.
That's a good way to put it.
It feels like they've already declared it a done deal.
Well, following the August jobs report, the market reaction was immediate and dramatic. It basically solidified what had been a growing expectation. Traders are now pricing in a 100% chance that the Federal Reserve cuts rates at the conclusion of its September meeting.
100%. Not 99.9. 100.
100%. This isn't just high confidence, it's near certainty reflected in market pricing. It indicates virtually no doubt among investors about the Fed's next move. It's a powerful signal of how much the recent data, combined with that official commentary, has shifted market sentiment.
And the breakdown from CME Group data really illustrates this precision, doesn't it? A staggering 98% chance of a 0.25% cut,
The standard quarter-point cut.
with only a tiny 2% chance left for a more aggressive 0.50% cut. It really tells you exactly what the smart money is betting on, right down to the specific increment. There's no longer a question of if, just maybe a tiny question about how much.
Precisely. And this certainty evolved rapidly over just a few days. Earlier in the week, even after the JOLTS report on Wednesday, traders were pricing in about a 95.6% chance of a cut.
Which was already very high.
Very high, yes. And that was up from 91.7% earlier that morning. But the August jobs data was the definitive push. It solidified that expectation to an undeniable 100%.
The final nail in the coffin for holding rates steady market-wise.
Seems so. And in response, stock futures were mixed overall, but notably, tech stocks were trading higher and bond yields were falling across the board. These are all classic market responses to soaring rate cut expectations.
Lower rates help tech valuations drive bond prices up.
Exactly. Lower rates typically make future earning streams more valuable, especially for growth companies, and they reduce borrowing costs. Plus, they make bonds with higher existing yields more attractive as new yields fall. The market is clearly anticipating cheaper money and has already begun to price it in quite aggressively.
Okay, shifting our focus now to another critical economic indicator that's been facing its own set of headwinds, the U.S. manufacturing sector.
Right, manufacturing's been struggling.
It continued what's been a truly sluggish year. Data from the Institute for Supply Management, or ISM, showed that manufacturing activity contracted for the sixth straight month in August.
6 months.
6 months in a row. That's not just a bad month. That's a sustained period of negative performance for a vital part of our economy.
Indeed, 6 months of contraction is a significant red flag. It suggests deeper, more persistent issues than just a temporary cyclical dip.
So what did the ISM number show exactly?
The ISM's manufacturing PMI came in at 48.7 for August. Now, while this was a slight increase from July's reading of 48,
A tiny bit better, but still.
firmly below that critical 50-point threshold, which, for our listeners, is the line in the sand separating expansion from contraction.
Right, below 50 is contraction.
What's particularly telling, though, is looking to the sub-indices. The new orders index actually saw some expansion, rising to 51.4.
Oh, okay, so orders picked up.
Orders picked up slightly. However, the production index, which measures actual output, fell to 47.8.
Ah, so orders up, but production down. That's weird.
This divergence is critical. It suggests that while there might be some underlying demand for manufactured goods, manufacturers are either too cautious to commit to increasing output, or perhaps they're grappling with persistent supply chain issues, and crucially, those tariff-driven cost pressures that make ramping up production unprofitable, even despite new orders.
So they get an order, but it costs too much to fill it profitably.
That could be part of the story. It's a very fragile, almost contradictory signal within the sector. Demand might be present, but the capacity or willingness to meet it profitably seems severely constrained.
Interestingly, data from S&P Global, also published on Tuesday morning, painted a slightly more positive picture for the sector, didn't it? Their U.S. manufacturing PMI came in at 53.
53, yes, above 50.
That was the strongest monthly increase since May 2022, according to them. It suggests there might be different ways to measure this, or maybe some underlying pockets of strength that the ISM didn't quite capture. Why do these two major indices sometimes diverge like this? And what should our audience make of these differing signals?
That's a great question about the technical balance here, and it's important for our listeners to understand the nuances. The divergence between ISM and S&P Global PMIs often comes down to differences in their survey methodologies, the company panels they use, and weighting.
Different companies, different questions.
Right. ISM tends to survey larger, more established manufacturing firms typically. S&P Global's panel can include a broader mix of company sizes. The specific questions asked and how they're weighted in the final index also play a significant role.
Okay.
So while S&P Global's 53 suggests some expansion, it might reflect strength in a different subset of the manufacturing sector than ISM's data captured. However, and this is key, regardless of these differing headline numbers, one consistent and pervasive theme emerges from both reports. Tariffs.
Tariffs again.
They're widely cited by manufacturers in both surveys as a major headwind, putting significant pressure on planning, sales, and costs across the board. The impact of tariffs seems undeniable, regardless of how you calculate the overall PMI. It's suggesting a universal challenge for the sector.
And our source material provides a truly powerful and frankly heartbreaking anecdote from the electrical equipment industry within that ISM survey.
Yeah, that was striking.
One contact explicitly stated that they've raised prices by an astounding 24% just to offset tariffs.
24%.
Think about that for a moment. Their margins haven't improved at all, despite significantly higher prices, because they're simply trying to cover the cost of these tariffs.
Just treading water at much higher prices.
And this forced them to conduct 2 rounds of layoffs, letting go of about 15% of their U.S. workforce. And these weren't just any jobs. They were described as high-paying and high-skilled roles. Engineers, marketing, design teams, finance, IT, and operations.
The very jobs you want to keep.
Exactly. This isn't just about factory floor jobs. It's about the intellectual capital within manufacturing being shed.
This raises a profoundly important question, doesn't it? How does this anecdote directly contradict the administration's stated goal of creating manufacturing jobs in the U.S. and bringing back high-skilled labor?
Yeah, it seems completely counterproductive.
This vividly demonstrates that tariffs, rather than fostering domestic job growth and bolstering the skilled workforce, can lead to the loss of precisely those higher-skilled, higher-paying jobs that policy aims to encourage.
How does that mechanism work exactly?
Well, the mechanism here seems clear. Increased input costs make domestic production less competitive, even with tariffs on competing imports sometimes. This leads to higher prices for consumers, squeezed margins for companies, and ultimately painful layoffs. It illustrates the very real human impact of trade policy on businesses and their highly skilled employees. It's showing an unintended consequence that is, frankly, the opposite of the policy's stated aim. It's a direct hit on the very segments of the workforce the policy was supposed to protect or grow.
And the impact extends far beyond just manufacturers and their immediate workforce, right? Retailers across the board are also feeling the squeeze, which ultimately trickles down to you, the consumer.
Absolutely.
Giants like Walmart, Target, Best Buy, they've all issued warnings that tariff-related increases are starting to creep into the cost of groceries, home goods, and electronics. This isn't some theoretical economic model. This means you, the listener, are starting to see these higher costs show up in your daily shopping.
It hits the wallet directly.
From your morning coffee to your next TV purchase.
And we've seen specific painful examples of this across different sectors already. Packaged food giant J.M. Smucker, responsible for ubiquitous brands like Folgers Coffee, Dunkin' products.
Yeah, staple.
They warned of more price hikes after the U.S. coffee profits plunged a staggering 22% under the weight of tariffs. Imagine the impact on their bottom line and subsequently their pricing strategies.
22% drop in profit is huge.
Huge. And Hormel Foods, the company behind household names like Spam and Skippy peanut butter.
Spam and Skippy, okay.
They also flagged the steep rise in commodity input costs. after missing earnings expectations, which sent its stock tumbling by 12%.
Ouch.
These aren't obscure companies. These are major household names directly attributing their financial struggles and, implicitly, their future price increases to the compounding pressures of tariffs and rising input costs. This illustrates a direct pass-through of these trade policies onto the consumer.
Walmart CEO Doug McMillon was quite direct in his assessment too, wasn't he? Stating, "As we replenish inventory at post-tariff price levels, we've continued to see our costs increase each week, which we expect will continue into the third and fourth quarters."
That's a clear warning of ongoing inflationary pressure from a company right at the front lines of consumer goods. No ambiguity there.
And Mickey Drexler, the former CEO of Gap, offered an even more ominous warning, essentially saying, "We haven't seen the worst of it at all."
Wow. That's chilling.
That's a pretty stark assessment of what might still be to come, suggesting these tariff-driven price increases are far from peaking. It paints a picture of enduring strain on the supply chain and, ultimately, consumer wallets.
And adding another significant layer of complexity to this entire tariff saga and introducing a profound legal challenge. A federal appeals court late Friday struck down most of President Trump's global import tariffs.
Struck them down. Okay, that's big news.
The court ruled that the executive orders imposing these tariffs actually exceeded his legal authority. This decision, if it ultimately stands, introduces a significant and potentially destabilizing element into the administration's trade policy.
So this 7-4 decision from the U.S. Court of Appeals for the Federal Circuit is a big deal then. It represents a major pushback against the executive branch's power on trade.
It does. It's a significant ruling.
But here's the twist. It allows the tariffs to remain in place while the administration appeals to the U.S. Supreme Court.
Right, so no immediate change.
So for now, both retailers and consumers are left in limbo over the future cost of imported goods. It's a temporary win, maybe, for those challenging the tariffs, but it doesn't immediately change anything for your wallet. It just adds to the uncertainty.
Exactly. It's a legal chess match playing out in slow motion, with very real economic consequences hanging in the balance.
What was the court's reasoning?
Well, the court's reasoning upheld a lower court ruling. It basically stated that the president lacked authority under the 1977 International Emergency Economic Powers Act, or IEPA, for these broad tariffs.
IEPA, what's that normally used for?
Good question. For our listeners, IEPA was designed primarily to grant the president emergency powers to deal with unusual and extraordinary threats to national security or the economy, often targeted against specific entities or countries, like sanctions.
Okay, targeted threats.
The court's argument was that applying it to broad global tariffs, which are akin to a general tax on imports, fundamentally stretched its original legislative intent. It infringed on Congress's constitutional power to levy taxes.
The power of the purse.
Precisely.
Mm-hmm.
The ruling emphasized a fundamental constitutional principle, stating, quote, "Tariffs are a tax, and the framers of the Constitution expressly contemplated the exclusive grant of taxing power to the legislative branch."
How did the administration react?
President Trump, in a post on Truth Social, responded by stating, in his words, that a highly partisan appeals court incorrectly said that our tariffs should be removed. If these tariffs ever went away, it would be a total disaster for the country.
Okay.
We report this simply as the factual reaction presented in our source, illustrating the high-stakes political and legal nature of this battle.
Got it. So how does this ongoing legal battle, this uncertainty and the relentless pressure from tariffs directly affect you, the listener, in your everyday life, especially as we approach, say, the holiday shopping season?
Yeah, that's the bottom line question.
Tom Essay, founder of Sevens Report Research, describes a K-shaped economy, which is a really vivid way to illustrate the divergence he sees.
K-shaped. I've heard that a lot lately.
He notes that higher income spenders are really keeping the economy going, and then the lower income spenders that are getting squeezed because they are feeling the impact of tariffs of inflation. That's a very bifurcated experience for consumers, isn't it? One group relatively insulated, the other truly struggling.
That concept of a K-shaped economy is crucial for understanding the current consumer landscape, and unfortunately it's reflected quite clearly in the latest consumer data.
Oh yeah? What's the data showing?
The University of Michigan survey indicated that consumer sentiment in August slipped again. It fell nearly 6% from July and over 14% from a year ago.
14% down year over year. That's a big drop in confidence.
It's a significant erosion of confidence, yes. More tellingly, perhaps, year-ahead inflation expectations climbed to 4.8% from 4.5%.
So people expect prices to keep rising faster.
It indicates that people are increasingly worried about rising prices, and they expect that pressure to continue. And tellingly, buying conditions for durable goods, those big-ticket items like cars, appliances, furniture, dropped to their lowest in a year.
Lowest in a year for big purchases. Why?
Primarily due to heightened concerns about high prices. This suggests that the impact of tariffs and broader inflation is deeply affecting purchasing decisions, particularly for larger, more discretionary items. It's pushing them out of reach for many, especially those in the lower income brackets of that K.
Right.
It underscores the fragility of consumer spending, which, as we know, is a major driver of the U.S. economy.
So after dissecting this incredibly complex web of a faltering job market, a surprisingly dovish Fed pivot, and the persistent turmoil of tariffs, what does this all mean for your portfolio, or maybe for those of you just keeping a close eye on the markets?
Yeah, how do you navigate this?
With bond yields already falling due to those strong rate cut expectations from the Fed, where do we look for signals? What are the potential plays here?
Well, this raises an important question. Can bonds offer some short-term stability in this kind of environment?
The traditional safe haven.
Potentially. The expectation of falling interest rates often makes existing bonds, which carry higher yields, more attractive.
Right.
As new bond issues come out with lower yields, the value of those previously issued higher-yielding bonds tends to increase.
Basic bond math.
Basic bond math. As a result, bond ETFs, perhaps like TLT, the iShares 20-plus year Treasury bond ETF, which tracks the performance of long-term U.S. Treasury bonds, could potentially benefit from this dynamic.
So TLT might catch a bid.
For an informed investor, this could be a consideration if you're looking for potentially lower volatility and maybe some capital appreciation in the near term, especially if this rate cut scenario plays out as the market expects. It could offer some shelter from market choppiness.
But there are risks, right?
Oh, absolutely.
Yeah.
It's also worth noting that bond markets can be highly sensitive to any unexpected shifts in Fed rhetoric or, say, a surprise inflation data print. Nothing is guaranteed.
Okay, so that sounds like a consideration for those looking for potentially lower volatility in the near term, especially if the rate cut scenario plays out as expected. A classic move when the Fed is easing.
Potentially, yes.
Now, we also observed that stock futures for tech were trading higher immediately after that August jobs report was released. That definitely caught a lot of attention. What's the thinking there? Why tech?
What's fascinating here is how quickly the market interprets these signals and, repositions itself. The prospect of rate cuts often signals a more favorable environment for growth stocks.
Like tech.
Particularly in the tech sector, yes.
Yeah.
Which tends to be more sensitive to borrowing costs than, say, value stocks.
Why is that?
Well, tech companies often rely heavily on borrowing for expansion, for R&D, for innovation. Cheaper money directly reduces their cost of capital, and crucially, it makes their future earning streams, which are often heavily weighted far out in the future.
Right, the long duration argument.
Exactly. It makes those future earnings more valuable in present terms when you discount them back at a lower rate. This could potentially fuel a relief rally as the market anticipates lower interest rates for a sustained period, making growth more attractive relative to value stocks.
So lower rates boost those future profit expectations.
It's a classic play. When rates are expected to fall, growth companies with high future earnings potential tend to shine as their long-duration assets benefit from lower discount rates.
So investors might be looking at this as an opportunity for some upside in the short term, given the Fed's rather dramatic dovish pivot. It's a direct reaction to the expectation of a more accommodative monetary policy.
That seems to be the market's interpretation, yes.
Okay, so in a slowing economy and uncertain market, where else can investors look for sectors demonstrating resilience? We just discussed how education and health services were actually adding jobs in August, which seems like a good sign of inherent stability there.
Right. If we connect this back to the bigger picture, the resilience we noted in the education and health services sector being the largest job creator in August by adding those 46,000 employees is quite telling.
Yeah.
This demonstrated stability in employment can often translate to potential resilience in related market sectors. Healthcare, in particular, tends to be less cyclical due to consistent, inelastic demand.
People always need healthcare.
People will always need medical care and education, largely regardless of the economic climate, making these sectors generally more defensive.
So for those considering defensive plays, healthcare ETFs like XLV, the Healthcare Select Sector SPDR Fund, that represents a broad basket of healthcare companies. That could be a point of interest.
Potentially. Given the sector's demonstrated job growth and that generally inelastic demand, it could make it a potentially more stable part of a portfolio during uncertain times, especially if the broader economy continues to decelerate, as the data suggests.
Makes sense. What about other defensive areas, like consumer staples?
Well, it's important to briefly mention a nuance there. While consumer staples, traditionally represented by an ETF like XLP, the Consumer Staples Select Sector SPDR Fund, are often considered defensive.
Usually are, yeah.
Our source material specifically highlighted challenges for some major companies in that sector, such as J.M. Smucker and Hormel Foods.
Right, the tariffs hit them hard.
Their struggles were explicitly attributed to tariffs impacting their margins and earnings. So, while typically defensive, the case for broad consumer staples may be more nuanced right now. It might require more specific company-level analysis based on this particular tariff-driven data, rather than assuming blanket resilience across the entire sector.
So you really need to look under the hood there, see who's exposed.
Exactly. You need to look at which companies are directly exposed to those specific tariff pressures, not just paint the whole sector with one brush.
Okay, good point. And lastly, for those with a higher risk tolerance, perhaps looking at derivatives like options. Given all this market volatility and the strong expectations around the Fed, what are the thoughts there?
Well, given the potential for continued market volatility, but also that strong expectation of a relief rally fueled by rate cuts, some investors with a higher risk tolerance might consider cautious option strategies.
Cautious being the key word.
Absolutely. These strategies can allow for participation in potential upside while potentially managing downside risk or expressing a directional view with limited capital. But again, caution is key.
So what kind of strategies are we talking about? Things like cautious bull-put spreads.
That could be one approach, yes, where you're selling a put option with a higher strike price and buying one with a lower strike price, both with the same expiration, to profit from the stock staying above a certain level.
Okay. Or perhaps light call buying in broad market ETFs like SPY, the S&P 500 SPDR ETF, or QQQ, the Invesco QQQ Trust tracking the NASDAQ 100, if you really anticipate a sustained upward movement from here.
Those are possibilities, but it is absolutely critical to emphasize the inherent and significant risks associated with options trading.
Definitely not for everyone.
Not at all. These strategies require a deep understanding of market movements, volatility, time decay, theta, expiration dates. It's complex. They are not for novice investors.
Do your homework.
Due diligence is paramount, and it's essential to fully grasp the potential for substantial loss, even total loss of the capital invested, before engaging in such complex instruments.
Yeah.
Options are not for the faint of heart or the uninformed. They can amplify both gains and losses dramatically. #outro.
Okay, absolutely essential warnings there. And remember, everyone, this deep dive is strictly for informational purposes only. It's our analysis and commentary on the provided sources. It is absolutely not financial advice.
That's right.
Always do your own research, consider your own circumstances, and consult with a qualified financial professional before making any investment decisions. Your financial future is far too important to leave to chance or just what you hear on a show.
So what does this all mean for you as you look ahead? The Federal Reserve is clearly at a critical crossroads, isn't it? Heavily influenced by this softening labor data and these persistent tariff pressures that are squeezing margins and raising consumer prices.
Yeah, tough spot for them.
The market has priced in that September rate cut with near certainty, effectively locking in expectations for now. But what happens next? Will this dovish shift be enough to stabilize the economy and maybe foster that elusive soft landing?
Or is this just the start?
Or are we simply at the beginning of a larger, more protracted adjustment? Perhaps even setting the stage for more aggressive policy action down the line if things worsen. The path ahead is, well, anything but straight.
Indeed, the questions loom large. Next week, we'll get a fuller picture of the labor market with new job openings numbers on Wednesday and, crucially, the monthly payrolls report for September landing on Friday.
More big data points coming.
Will this further confirm the Fed's dovish pivot and maybe fuel the market's rally? Or will new data throw a curveball into the market's current trajectory, forcing yet another reevaluation? Stay tuned, because this economic story is clearly far from over.
Understanding these dynamic shifts, the subtle nuances between reports and the underlying forces shaping our economy is absolutely key to navigating your own financial landscape. Keep digging, keep questioning, and always be prepared to adapt your understanding as new information emerges. The only constant in these markets, as they say, is change.